Harsh Arora, a partner at Phoenix Legal, and my current practice spans a wide spectrum of legal services with special focus on banking and finance, restructuring, infrastructure, and public private partnerships. Today, I will be sharing my thoughts on green finance and green bonds. Green finance is an umbrella term for the increase in financial flow from public private sectors to green and sustainable development projects, including the production of energy from renewable sources like solar, wind, biogas, etc. To meet the monetary requirements of these kind of projects, new instruments like green bonds and new financial institutions, for example, green banks and green funds, are being set up, and they together comprise of green finance. India has started emphasizing on green finance as early as 2007. India has set up an ambitious target of 450 gigawatts renewable energy generation capacities by 2030, and for achieving this target, green finance can play an important role. Green bonds are the bonds issued by any sovereign entity, intergovernmental groups, or alliances and corporates with the aim that the proceeds of these bonds are utilized for the projects classified as environmentally sustainable. The issuer of these bonds gets the capital to finance green projects, and the investors get a fixed return. SEBI has issued a circular on 30th May 2017 setting out the disclosure norms which would govern the issuance and listing of green bonds besides the existing SEBI guidelines. The government is likely to launch green bonds by end of June 2022, and these are expected to be medium to long-term bonds whose major part of the proceeds will be dedicated to renewable energy sector. According to Climate Bonds Market Intelligence, green bonds worth USD 500 billion were issued in 2021 globally. Total issuance is expected to reach USD 5 trillion in 2025. Most Indian firms turn to London Stock Exchange to raise funds through green bonds. As of 2021, India has the second largest emerging green bond market after China. More importantly, the potential of these instruments have been harnessed not only by corporations like Jindal Hydro and Adani Greens, but also by government instrumentalities to meet their sustainable developmental goals. However, considering the cost of these bonds of around 5 to 6% and adding the hedging cost of 3% makes these less cost effective as compared to masala bonds.